Welcome to the Real Advisor Podcast, TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear Trappists. Welcome back to what many people are calling episode 69 of Le Podcast du Réel Conseiller, the Real Advisor Podcast, TRAP, TRAP. My name is officially Lick Ninken, and joining me as ever in the digital studio of doom are the three other horsemen of the apocalypse. Andy, Ultra Heart, Alan, the Storyteller Smith, and Carl, the Voice, de la Voce Widger. Now, gentlemen, we have a show packed full of absolutely nothing. So let's start unpacking it straight away with some more high energy review reads read out by my very good friend, the Right Honourable Mr. Andrew Ursane Hart.
Thank you very much, Nicholas. The first review and only review today is from Tom Robert Shaw in 5 stars, entitled "The CII, CISI and LIBF should provide credits for each episode. It's that good." Hello, Trap Pack. I just wanted to say thank you for creating this show. I'm a 30-year-old chartered financial planner. And before listening to this show a year ago, I was disillusioned with the career path I had taken. At this point, I had done 16 exams and had been a financial advisor for 4 years. Sure. And I really needed help and guidance from an experienced financial planner. I felt I wasn't offering great value to the people I served and questioned the integrity of the industry. However, TRAP came into my life and things changed. I've learned far more from you guys than I have for the last 5 years of relentless study. It's the show I always needed. I'm now lucky enough to be self-employed with my own client bank, and I'm providing full financial planning with all of my clients, and they are loving it. The show has given me a new sense of purpose, and I now look forward to going to work and delivering real value to my clients. I really look forward to thanking you in person at TRAP Live in May. 6 out of 5 stars. Thank you, Horseman, Tom Robert Shaw. Back to you, Nicholas.
That is just an absolutely brilliant review. Thank you, Tom.
Brilliant,
That's wow, that is so powerful, and thank you so much. And keep them coming, Trappists. I keep on saying it, but it's absolutely true. We've all got egos, believe it or not, and they give us a real shot in the arm. We're not screaming into the void. That we do have Trappists who get value from this. Much appreciated. And of course, Tom, we're looking forward to seeing you at TRAP Live, which is coming up shortly. So let's put a timestamp on this episode and move straight on to the topical tidbits for episode 69.
Hello, my lovely Trappists, it's TLP here. Looking forward to catching up with all you miscreants on Wednesday the 14th of May at TRAP Live 25. Many people are already calling this the biggest part of TRAP yet, and you don't want to miss out. Shits and giggles with Ultra, Storyteller, The Voice, and my imbecile of a husband. So head over to therealadvisorpodcast.com and purchase your tickets. Now, back to the latest pile of TRAP. See you soon.
There we have it. We have, guys, don't we? This is, in all seriousness now, the capacity is 150, and we have 10-ish. Ultra, you're on top of the diagnosis for this. About 10 left?
about that, a little bit less, Nick. So yeah, they're genuinely, the last handful is available. So yeah, please do grab one. It's the standard ticket price now. The early bird has stopped, but still great value. So yeah, go to the website, therealadvisorpodcast.com, and grab the final handful.
Great stuff. And in the last week or so, we gave out half a dozen. No, actually, it was 7 in the end, wasn't it? After a typical TRAP Pack argument. 7 scholarship freebie tickets to those that applied. We had about 30 people apply. So if you haven't got an email saying you've got one, I'm sorry, you haven't got one. It was difficult deciding on really difficult deciding on the 6 and then the 7. So that's all done and dusted, and we're looking forward to those people coming along who may well have to stand if the tickets go as they keep on going. Okay, let's move on. And who's the first one? Timeline charts from the Storyteller.
Just a quick pointing out of some really valuable resource which is available. They do it every year. Our friend, actually, I've got to do the full disclosure nowadays, so I don't end up on the front page of New Model Advisor, and as does Andrew, because I own 0.0001% of the timeline.
Conflict.
Our good friends Timeline Tech, and all the stuff that they do.
You would say that, though, wouldn't you?
Friend of the podcast. Yes, you would. Friend of the pod, Abraham, has created. They do this every year. I think it's really valuable. They provide a whole suite, charts, graphs, just stuff that you can use within your business, things that you can share amongst your team, amongst your colleagues, amongst your clients. I've always got kind of two minds about charts and graphs for clients. The best thing is to just have a great conversation, but occasionally they can be used just to make a point, just to sort of get to the nub of the issue that you're trying to convey. So there's an entire suite of charts and graphs, tables updated for 2025 available. There's a link to find it in the show notes, together with a video from the legendary Abraham Okasonyo. So well worth checking out, particularly in these slightly volatile times.
S&P still not down double digits since the tariff tantrums have started, but please put out emergency podcasts. Voice, when a rule becomes a loophole, this sounds, be still thy beating heart.
Yeah. Before I start, can I just say I'm getting loads of messages on LinkedIn, as I know you guys are, about people who are going to come to Trap Live, and it's actually really inspiring stuff. And I just wanted to say, before I forget, or in case I forget, that thank you for all those messages. I know that you guys have got them as well. And we were talking just before we came on, maybe because of the kind of demographic of the folks coming along, we might do something like talk about how we started in the business, how we got into full fat financial planning and that kind of stuff, because that seems to be what people are after and what they're looking for. But look, it's fantastic. I'm absolutely just so genuinely so excited to do the event and to meet everybody. So really looking forward to it. And also to Penny, that was an amazing piece of audio. And you're sweet and Nick Lincoln are not two words that kind of go together, but it was so sweet watching the big proud head on you as you played that. So everybody definitely watch this on YouTube.
Oh, thank you. I wasn't aware. Thank you for that.
Well, it was lovely, and rightly so too.
Anyway, you soft shite. Get onto when a rule becomes a loophole.
Yeah. So the loophole. So this one is
Let's get on to
nuts.
some Irish pension legislation now.
This is a perfect segue.
Scams.
Perfect
Pension
segue.
scams.
So this is do you remember I was saying the Piers A's you could put in as much as you want, and loads of wealthy people were putting in 1 million and 2 million into their pension pot. Right? It was fantastic, right? And it's the market we're dealing with. So did we make our clients aware of it, and did some of our clients avail of it? Yes, they did,
of course,
because they were the rules.
Yeah.
And then there's an article in the paper quoting a inverted commas confidential revenue paper, saying that people availed of this loophole, and basically it was a joke. And I'm like, yeah, but you told us that these were the rules. We played exactly to the rules. We did not break the rules at all. We played exactly to the rules. So now you can't come back because it didn't work exactly like you said it. Because what is happening is some of our clients who did avail of it are going, here, hold on a second. I saw it. It's in the paper again. It's in the paper again. It's in it. And we're like, no. We have played exactly to the rules. We have advised you based on revenue law at the time. Now, maybe if they had listened to the practitioners in our profession, we would have been able to identify some of these issues for them and say, that's probably not exactly what you're looking to do here, because here's what will happen if you bring that in. But they didn't talk because they just decide themselves to make up these rules. Anyway, I just wanted to say it because there's surely loads of other really great advisors out there who brought this to the attention of their clients, and their clients availed of it. We need to just be absolutely clear. We did not break any rules. Our clients did nothing wrong. They've changed the rules subsequently. That's fine. We will now play to the new rules. It is not a loophole. It was a rule at the time. That's all I want to say about it.
Well said. In this country, we had the annual allowance once was £255,000 a year, wasn't it?
Yeah.
And it was almost too good to be true, and it was too good to be true, and they soon changed that. Not quite the same framing of you saying it's a loop. You've been told it's a loophole that's been exploited, but it was, they obviously decided that's way too generous, because guess what? People are taking advantage of it. And it went down to 40K, didn't it, for a number of years, and it's now crept back up to 60. Still nothing like
but I would say, you guys are talking a lot about, the really wealthy folks leaving the UK now, right? So to take a step back and go, look, we need to encourage people who are, in a lot of cases, generating a lot of jobs, generating a lot of tax, et cetera, et cetera. We got to create some ways for them to extract wealth in a tax efficient manner. Not all of these are bad, because if you just tax and tax and tax to the hilt, well, that's what's going to happen. Exactly what's happening in the UK.
Well, welcome to our world. Welcome to our world. Absolutely.
Yeah.
Okay, thank you for that. PRSA Corner for this episode has been closed. And moving on.
Sponsored by.
That company who I won't mention again because it wouldn't be fair because they didn't pay us. But they got on to me. The MD was like, "Hey, Carl, that was magic. Thanks very much." I said, "Hey, it'll cost you again. It'll cost you if you want another mention." So I'm not going to mention Royal London again.
Oh! Okay, quickly, let's get away from this. Ultra.
Okay, a couple of points to this story. There is a change happening with the IHT exemption for AIM shares. AIM shares are listed on a sort of smaller stock market, and it's younger companies, growth companies, and there's a whole sort of reason to invest in them. So currently, qualifying AIM shares 100% offset for IHT when you pass, but from April 2026, it's going to be reduced to 50%. So there's going to be a big impact in this space and market. Myself, Nick, and Alan are not too pro this strategy for reducing IHT for various reasons. From a high point to a low point, the AIM index is down 18% this year, which is slightly more than the sort of main market. But HMRC believes that they're going to raise about £110 million, which in the grand scheme of things is not too much per year once they introduce this change.
God,
you mean a rounding error?
We're talking about, like you just mentioned, called government legislation, and guess what? They don't really know what the hell they're doing. They come in with these crazy pension rules, then they backtrack on them. And this 110 million. I mean, I can't remember. I mean, that's about an afternoon of sponsoring the NHS or something like that.
Yeah,
it is such
probably not even that.
Probably not even that. It's such a rounding error. But it's the message. Now,
it's the symbolism of it.
To me, that just completely decimates. When you say reduced by 50%, so it's a 20% inheritance tax charge as opposed to a 40%.
Well, it was 100% exempt. Now it's going to be 50%. You're right.
Right. So it sort of works out. So you get
remove the 40%. Now you're going to.
So, sorry to interrupt there, guys. So in the past, you'd have these AIM ISAs, wouldn't you? Where you invested. As long as you held them for 2 years, the money would be outside of your estate. And now you're saying you're only going to get half the credit for that.
Yes,
AIM ISAs and AIM portfolios in general. So people
which have been dog for years.
Well, they've been terrible, but people have invested in them to remove. You could put as much as you want into an AIM portfolio, and then after 2 years, historically it was removed from your IHT estate, and now so now only 50% of it's removed from your IHT estate.
Yeah.
The trade-off that you are making as an investor for investing in these super volatile and clearly very poorly performing, if you look at past
low
performance,
returns,
you can maybe make an argument for it if you completely exempted yourself from inheritance tax. But now, I think, why would anyone do it? It's just.
And sorry, Andy, if you mentioned this when you were talking about it, is that retrospective? Or is that from all new investments into these? It's just going to be half the credit you got before.
So currently, if you die now before April 2026, all of it will be exempt as per the current rules. The new rules are coming in April 2026. They're saying that they're going to raise 110 million. That's in year one. Then the market's going to be, as you rightly said, Alan, slowly decimated. So the take from it's going to become less and less and less. Anyway, this article was in professionaladvisor.com, which out of all the news sources, I think is one of the best. So my following on point to this initial point is join new professional advisor. There's a link in the show notes. Professional advisor, join, and they've got decent news coverage. I'll send you like a daily email, like a roundup or something. So that's another point to mention. So that's in the show notes as well. Over to you, Carl.
Me. For what?
Carl, wake up.
I'm just, that was amazing, that segment on name. Why am I being brought in?
Low and slow.
Oh, yeah. Okay. Yeah. So this is... This is about Irish Irish depositors, right, are keeping their money in kind of overnight deposit accounts or very short-term deposit accounts. And so this report reckons that they've given up by just choosing the wrong deposit type of account. In 2024 alone, they gave up 800 million of unearned interest by just keeping it in kind of overnight deposit, which, okay, that might sound like a reasonably small number, but it's a big number because Ireland is a really small country. And this goes back to what I said in the last episode and the episode previously. Like, imagine the wealth we should have created in this country. But anyway, this is not a report done by Metis Ireland or a stockbroking firm or a wealth manager. This is a report from the Central Bank of Ireland. Our own central bank have come out with this report. So basically just stating facts. Here's what you could have got. Here's what you did get. So come on, Ireland, and come on, Irish depositors.
Our RFCA, which is another bureaucratic, obviously quango, like your central bank would be, but they have recently started coming out using phrases like the risk of being in cash when inflation is relatively high. The one thing I'd say about that, Carl, is what the central bank is saying is people are missing out on these higher rates by languishing in lower rates. But of course, what would happen in the real world, and these people don't often exist in the real world, do they? Because they're academics and they're unemployed in suits. If people piled their money into these higher paying accounts, those banks would then immediately drop the rates because the markets would adjust accordingly. So it's not like a static game where, you've missed out on 6.2 and you're only getting 3. If everyone had piled into 6.2, that would soon be 3 or less because the bank would have the liquidity it needed to offer the rate at 6.2 in the first place. So I take it with a large pinch of salt.
I don't know. Some truth to that.
No, I'm right.
I love the way you get all the stuff in Ireland totally correct all the time.
Well, these are universal truths. These are universal truths.
No, because Ireland only has, what happened after the financial crisis is Ireland is left with 2 pillar banks and kind of one other smaller bank. Everybody, and they're just the Irish banks, of which the Irish government had to bail out. And everybody else left, said, this is a shit show, we're getting out of here. So what has happened over the last couple of years is the likes of Revolut have come in, and there are other banks now like Raisin.ie who are European banks and are offering better rates. And yes, the AIBs and Bank of Ireland's of this world have put some term deposits on. So if you lock your money up for a year or 2, yes, they have introduced those. But there are competitors out there now who it will take time for them to start eating the lunch of the pillar banks here, but it will come true. It will come true.
You guys remember the Icelandic banks?
Ice Bank. Yes, paying 7 to 8% at one stage.
Yeah. Go.
Thor.
Yeah. Close personal friend. Another story for another time. The young viewers and listeners will probably never have heard of this stuff. In 2006, 7, 8, 9, Iceland, a population of 300,000. Suddenly it became the banking center of Europe.
That's right. But I think it's regenerated itself from that car crash, and I think once again Helsinki is a very strong.
Helsinki.
Is it Helsinki? What's the capital of Iceland?
Reykjavik.
Oh, whatever.
Reykjavik.
Details. I'm not a details person. It's now
Finland, Iceland.
Ireland.
They all
one
end
bank,
up with land.
15 banks. Just talk sternly as if you know what you're going on about and get through it. I do remember that period of time, sort of 2005 to 7, when these banks were offering crazy, and in this country, Northern Rock and so forth.
Yeah.
And that was on the back of the the middle of the lost decade for equities, and people were saying, "Hold on, I can get 7% guaranteed in the bank." And since March 2000, my portfolio of the great companies is actually underwater. It was a tough
sell.
It was a tough sell.
Yeah.
And I like in response to that, then the likes of Raisin.ie, they'll only allow you put 100,000 up to the European government guarantee in each provider. So it's they
they actually limit you on that, Carl.
Yeah, they do.
Oh, wow, interesting.
Yeah. So it is rock solid secure as long as you're happy with. This is not advice, of course. But if you're happy with government guarantees, well, then it's as secure as you are going to get. Yeah. Now, it's another argument altogether about the erosion of the value of your money over time if you're only putting it on deposit and all that.
Oh, yeah, absolutely.
But there are better deposit rates, and the central bank are producing a report to say, yes, there are, and we're frittering away money. By not choosing better deposit rates, even within our own pillar banks, if you don't want to go to some of the new providers. Just thought it was interesting.
Okay, cool stuff. Right, here's an old canard that's come around again, thanks to Ultra.
Yeah, this does the rounds, doesn't it? The safe withdrawal rate. What percentage of your money can you take out of it once you've hit financial independence and ideally never run out of money? Motivator has done a deep dive on the UK safe withdrawal rate. It's done a 2-part series. I don't know if you boys have clicked on the link, but there's an interesting chart right at the bottom that goes back to 1870. I mean, God knows where they're getting their data from, but 1870, and then running a 60-40 UK equity, UK bond portfolio, and running that over a 30-year retirement period. And it gives you which number of percentage return you could have started out by taking and sort of continued it successfully. So out of those, 150 years or something, there's only been probably about 30 years where you couldn't have taken a continued withdrawal rate of 4%. So what I'm saying, even on the basis of, I mean, this is a spreadsheet problem, not a real life problem. We know that, humans adjust, they spend less, spend more, give money away, new money inflows come in, they, downsize the house, upsize, stuff happens, and they don't just drive off the cliff, they re-edit their behaviors. So they don't drive the car off the cliff. But on spreadsheets, these problems are a math problem. But yeah, it's looking quite positive for the 4% with withdrawal figure. As in, this is just UK numbers. It's 60% equities versus global numbers, an increased equity exposure. So yeah, it's quite good reading if you are into this sort of stuff. I know some financial advisors love this stuff and they, discuss it at length with their clients. I mean, it's a good, rule of thumb. If you've got X size of pot, the perceived wisdom is you can take this much out of it and you're not going to run out of money. But obviously exceptions apply. Yes, that's that. Motivator is good. We've spoken about them before, so that's a strong link for their blogs and research and stuff that they put out, and also a bit of update on safe withdrawal information. That's it. Over to you, Alan.
It's a heuristic, Andrew. Do you know that? It's a heuristic. It's a heuristic. That's all it is. It's a rule of thumb, and and that's where great financial planners do the work, because life is never according to a rule of thumb.
Never a spreadsheet problem, yeah.
But it's just a conversation, and it's not bad. And so they're basically saying, you wouldn't go too far wrong.
No,
withdrawing at 4%.
There's been some obviously horrendous periods, World War One, World War Two, but I mean,
But overall,
yeah.
Interesting.
Okay. I think Ultra was giving you a segue into your piece on Fisher, rather than just asking you to talk about heuristics. But I'm just flying kite.
Right. Thank you. Thanks for the nudge.
It's been a long bank holiday weekend, hasn't it? Jesus
God.
Ultra's running on fumes.
This was just I saw this come up. I thought I'd bring it to your attention. A company called Fisher Investments, who are a US business and got quite a sizable operation now, I understand, in the UK. We've probably all got our experiences to one degree or another. I don't know them at all. I know of Ken Fisher in the US, the founder of the organization, and I know that Ken Fisher is a billionaire and he runs does lots of things, but he runs this RIA, which is an IFA in the US, and it's a pretty big organization. But I just kept seeing, I don't know if I'm hitting their age group. I'm in the profile. I keep seeing their adverts everywhere.
Everywhere
they come up. You guys all see them. And
LinkedIn, the Times, yeah.
So I just paid a little bit more attention to them recently. Quite interesting. If you go on LinkedIn and if you click the ad, it tells you how many people, because it's a classic, provide you with some material like, a lead magnet, provide you with, the 10 things you need to do before you retire, as long as you've got at least £500,000, big caveat in it as well. And so you download it, but it on LinkedIn, it shows you how many people have downloaded that particular thing. And I saw one article and there was like 3,500 downloads of that document. Now, quite a few of them, I think, are other advisors having a look. But within that number, you're going to be a couple of thousand leads, effectively, people who have effectively put their hand up and said, I'm quite interested in this. I've pre-qualified myself as having at least £500,000 of investable assets. And they'll get a call, and they are now in the system. And I remember a couple of years ago. I can't remember which podcast it was on, but there was one American financial podcast, and the guy he was doing something else, but he used to work. He was like headed up the marketing team at Fisher, and he said that it's just an absolute money making machine. They're so all over their data, the analytics. If you just if you post your LinkedIn thing or your newspaper advert or whatever it is on a Tuesday at 3:00 versus a Friday at 4:00, and all this stuff, and they just fine tuned it. And they are an absolute growth machine. They are just flying in terms of business growth. I just find it quite interesting. You guys seen them? You've seen it, Andy. You've downloaded this.
Do you want to go, Carl?
Yeah, I very active here. We've actually gone through their process, right? So you have to put in a phone number, and if you put in a dodgy phone number, it won't let you through to the next stage. You put in the wrong email, blah blah blah, right? And then so we did do it, and you get a report, a kind of 8-page report about successful investing. Actually interesting, Andy. Some of it's about how much you can afford to take down on retirement, that kind of stuff. It's really good. Look, we've probably, because we're in the business, we know about Fisher Investments and Ken Fisher and all that kind of stuff, right? Leave that aside. If you want to grow a serious financial planning firm, you got to learn from firms like this. They are absolutely smashing it, as Alan says. They're not afraid of sales. So sometimes I think we get, and I've said there's loads, right? Too angelic about just doing financial planning and not doing marketing and not want to grow, and sales is a dirty word,
service,
right?
Not sales, yeah.
They're like going after it, and it is incessant. When they get your phone number, your email address, they're getting that meeting with you. You know, they really are.
That's the bargain that you make. They've given you something of value, so they say, in return, all we want is a phone call with you, just to ask how we can help. And I tell you what, it works.
They are insanely prolific, and they are all over the marketing, as both of you guys have said. I think their original one, how long would 250,000 last?
It was 250. It was 250.
In retirement is the most successful. Again, I don't know the comparisons, but I'm just assuming it's one of the most successful financial.
No, it is. It's known to be the most successful financial ad ever.
In recent years, they've nudged it up to 500,000. I think I've seen 750. Again, they're just testing it. ABC testing different numbers, different people. And it is a lead magnet, classic. My advice to financial advisors out there, just clone exactly what they're doing. Exactly. They don't own how long will £250,000 last in retirement. There's no proprietary information there. And just go all in on a heavy LinkedIn campaign. I don't want to deal with 800 inbounds. My life would just be too busy. But if I had a firm where I had loads of advisors that wanted to deal with that level of inbound and that level of client, just clone it. There's no financial promotions when you're selling different gold funds and different periods. You have to quote a load of historical data compared to this and compared to that. This is just general high level information about more financial planning. So to just clone it, it's insanely successful.
Okay,
100% agree.
Yeah, change the name to Fishy Investments. How long would £251,000 last in retirement? Just make some subtle changes around there. Okay, who's next? Wodge, smaller companies, the case for smaller companies. Please, Christ, let there be a case for smaller companies.
Yeah, so before I go on, Nick, your microphone is after doing that weird stuff again.
Exactly what it's doing again.
Yeah, exactly. Okay, so this is a 15-page report if you want to support the case for smaller companies. So Andy kind of mentioned it earlier on. Sometimes you might need or want to have your research done or to send a research document to a client as to why that you should mute Nick just for a sec. If you want proof or research as to why smaller companies might be a good idea, then this is the report for you. It's quite detailed, but interestingly, if I asked you how the S&P has outperformed the Russell 2000, which is kind of the smaller companies index, obviously because of the Magnificent Seven over the last three years, correct? What did it outperform over the last 5 years? What would your instinct tell
versus
you?
The Russell, Carl?
The S&P versus the Russell 2000. So,
well, I'm going to say no because you've asked the question in that way.
Yeah. So
you would actually think yes. You would actually think
that the S&P has.
You would feel because it's been flying
over 5 years. You're right. It has over 10 years.
Right.
Over 10 years.
Yes.
Yes. The S&P has. And over 20 years, has the S&P outperformed the Russell 2000?
No.
Yes.
Yes, it has. So here's the thing, right? So is this the dawn of a new era, right?
You mean smaller value?
Right? Yeah. So are these tilts still worthwhile, or should we be looking elsewhere? Now, if you believe that the tilts are definitely worth it, well, then you should be going all in on funds that have tilts towards smaller in value, you know. But also, I think you need to avoid sometimes the echo chamber. And I think that you need to consider maybe the alternative here. And so the report does say that you should not just go into smaller companies, that maybe it's smaller companies with some active management. Now, that's a bit that we're all kind of going to go, whoa. But all I'm saying is, you know, this report basically says that it's a big opportunity for smaller companies right now. The figures would tell us that. Our instinct would tell us that. Here's the proof behind it. Here's some research behind it. But also, I think you need to challenge your own beliefs. And when does something that was historically the case become maybe not the way things are going to be going forward? And then obviously the counter argument is, oh, well, this time it's not going to be different. Well, there's 20 years of outperformance there that maybe we should be considering. So look, I'm just putting it out there as just to kind of maybe, I don't know, prod some debate here, but it's an interesting report. I did read it to basically confirm my own echo chamber that this was the way to go.
Also, it's the emerging markets as well. You know, the emerging markets going to
Well, here's the thing.
start to beat the mainstream again.
I actually read that as well, Carl, briefly. There's a lot in there if you want to really get into detail and unpack. And one of the things they talk about, which is kind of, I think it's the accepted wisdom, is there's the reversion to mean. There always is this thing, and sometimes the reversion can take decades, which is happening. And they're talking about that as being, I mean, I don't know, what are they called? Research associates? I can't remember who they are. They're not a fund themselves. They are proper sort of independent research affiliates. It's a well-written paper. It kind of backs up. You could argue, I mean, all of us, to one degree or another, embrace the DFA in a dimensional philosophy, and then the juries are as to whether they are an active manager or not, because they don't slavishly embrace the index, small cap or otherwise. The paper also referred to other factors such as momentum as being an important aspect. So they're kind of alluding. The way I read that was, well, if you've got some dimensional funds and these guys are right, you're probably in the approximate right ballpark to capture some of this future potential upside with a smaller cap.
Yeah, but they're not saying you should just take a passive approach to the smaller companies. That it's more of an active approach. So look, there's stuff that I didn't agree with, but look, I don't know, because nobody knows what's going to happen next year, 5 years, 10 years, right? I know diversification will help you, so you know, and that's in terms of styles and everything else. So. I'm just saying it's good to challenge yourself, because, as I said, I went for confirmation and I was challenged when I read the report, but I thought it was really well written. And I, for one, right, having supported DFA with my own pension money,
Likewise.
I'd love to see the Russell 2000 outperforming in 3 years' time. I'd like to be looking back on, Jesus, you remember I was questioning that, and you know, I would like to see that wheel turn. Sometime soon, please. Thanks very much.
You've got to be patient. You got how bloody patient.
Yeah, exactly.
Quick aside on this little tip. I put that paper, because that had come to 27 pages or something, quite a lengthy paper, and I put it into Google LM. Everyone's used it, and it built immediately straight away a mind map. So it extracted all the relevant points, and then the sort of the key 3 or 4 points, and then the sub points. I'm quite a visual person. A mind map, if you ever come across sort of quite weighty documents, but pop them into Google LM. LM, yes, one of the Google suite of AI tools. This is the one that you could create a podcast
of it,
from it if you wanted to. But it does lots of different summaries, short notes, but mind maps are pretty good. I think you just get
I just wrote it down, which means I will never, ever follow it up.
No, because you've written it down. It means you will follow it up. That's the joy of writing things down.
No, you don't know how this silly brain works.
All right, onwards.
No comment. Okay, so I've changed microphones. Trappist, hope this one's more bearable. If it's not quite as good as normal, I apologise. Hargreaves Land. Oh, this has got to be ultra. Yeah, go on then. Give us your Hargreaves. Give us your dose of Hargreaves.
Well, this is somewhat interesting, I find. So Hargreaves Lansdown is one of the biggest investment platforms out there. They do great work for end consumers and promote the investing culture. One of the founders, Peter Hargreaves, is going back to work at the company or joining the board at age 78. He's built the machine to allow Middle England to retire. And he retired at 68. He set up another investment firm. Now he's going back to the firm that he founded after a 10-year hiatus because the firm has just been bought by private equity. Is it good to always have purpose and work, or should these individuals genuinely go off and retire? I know it's dependent on the individual, but I thought it was quite interesting. I mean, why would private equity want to buy this firm after it was set up in 1981 and get the 78-year-old founder back on the board?
What was the business he set up? What was the business he set up between? No, I know Hargreaves.
Sorry, he set up Blue Whale. It's called Blue Whale.
It's called Blue Whale or something. It's like
an investment fund.
A fund manager that was heavily promoted on Hargreaves' platform, I believe.
All right,
I think they got about 3 or 4 billion, like a successable company, but nothing compared to what he previously created. So it was a bit of a sort of retirement project.
I think it's well publicised that Peter. You can't forget about his baby that he created in a basement in an office in Bristol, and he
1981.
He was very, very critical of the way the company was being managed.
Yeah, he was. Yeah.
Felt really underperformed.
He didn't want them to go down the advice route. He didn't want them to provide tailored advice, regulated. He just wanted to do everything super fast, online, digital, direct to consumer.
Obviously, he's still, of his billions, he's still got, a lot of it, if not most of it, still wrapped up in shares in HL.
I think he's actually sold his last chunk, but anyway, he's worth a few quid, and he owns a rugby team.
He sees it as a challenge, doesn't he? I'm sure. He's still got the energy. He was certainly very vocal about the way the organisation was being run. It's being taken private now.
Yeah, sure. Isn't there a guy that age running America?
Exactly.
It's sort of
about the same age, isn't he?
Yeah.
Yeah, for sure.
It can be done.
Terry Smith's in his 70s, isn't he? So,
never retire, people.
Well, I think with Jack Bogle was an example where perhaps it wasn't a great thing because he hung around Vanguard, and it's quite clear it wasn't a particularly productive relationship. So maybe you got to know when you got to move on. Talking of which, should we move on to the next point? As we're about, I'm going to guess we're 37 minutes in, because I think I crashed out to change microphones at 30 minutes, now it's telling me 7 minutes 30 on my calculator, my timer. So 37 minutes in. Okay, well, at the start, Storyteller mentioned the timeline charts and how they're useful at these times where all asset classes seem to be volatile in a downward movement. And when that happens, we often get this call for alternative investment. They seem to rise to the top of the cauldron. And so they have at the moment, and this article from the Wall Street Journal, I have put it into the so-called show notes, and I think I've made it, it's a public article, so it shouldn't be behind a paywall. And this is from Jason Zweig, who writes these, I think, a weekly missives, very good. And he starts off by saying, with the stock and bond market stumbling in unison, investment firms and financial advisors are pushing so-called alternative funds harder than ever. This week, the Wall Street Journal reported that Blackstone, the private markets giant, is partnering with Vanguard and Wellington Management to create portfolios that will mix publicly traded and private assets. And then he goes on to really slag off private assets and how the people that own them, the institutional investors, are trying to get out of these things. They're very highly illiquid. He quotes the US university endowments, which are just massive. I mean, Harvard's runs into the billions and billions alone. And they invest heavily in private equity and alternative assets. And over the last decade, the average endowment in the US has returned 6.7%, having invested a lot in these private equity investments, whereas the S&P has nearly returned double that. And Jason Zweig makes the point that an ETF invested 60-40 over the last 2 years would have grown at 6%. So these are highly speculative, highly illiquid. You can't even, if you put these into client portfolios, I'm not sure how your rebalancing process is going to work if you do it. And it's the age-old thing, and this is more the important point that I'm trying to convey, is that don't go with what's working now, go with what's always worked. Just because we've suddenly had a bit of a tremor that these things are coming to the fore. There was an article on LinkedIn, wasn't there, from an advisor who follows Trapp and is a fan of Trapp, saying that his younger advisors are coming to him asking to be put into this stuff. Which I hope. Well, I'm assuming that is the truth. I hope it isn't the truth en masse, because for me, it's just, you know where this is going to go in 4 or 5 years' time. You just know this will be some sort of car crash, and where there's blame, there's a claim. You guys have any thoughts?
Just pretty staggering numbers. I've just read in the article, Nick. Private equity firms are sitting on more than 29,000 companies valued at $3.6 trillion. And they can't unload them.
That's right.
Obviously, they can unload a few, but I didn't
realise
unload
them to retail. This is the point.
Or shift them between each other. You know, usually PEs to PEs to PE, then to some endowment. But 29,000 companies. Wow, that's an insanely big number.
That doesn't surprise me. I am in complete agreement with this. The sentiment that the article, first of all, the sentiment you've raised, Nick. Do you know what? This is one of the really important things, I think, as thoughtful financial planners that we all are, not to go with the fashion and the current trend and the latest thing. We are all now getting this stuff. There's inbound from emails from various companies. I mean, I got to say, I'm slightly surprised by Vanguard embracing this.
Yeah.
You know, a company, their whole ethos, their history, their whole thing, low cost, index, buy the market, buy the public markets at the lowest possible cost. This seems to just sort of, you know, be in sort of to challenge that original kind of ethos of the
absolutely. If it was a classic active, you know, US massive fund like Fidelity perhaps, or a Fisher kind of RAI pushing this kind of, you can't totally get it, but Vanguard and Wellington Wellington do active funds, but really, really cheap. You know, they embrace the bank, because they kind of, I think they work in unison, don't they?
Well, they're very close. It wasn't Jack Bogle originally at Wellington.
He went nuts when they went to ETFs, didn't he? He'll be going nuts over this.
But you know, I think that this is an important point for any of our audience to listen to, because I increasingly see this stuff coming out. We've got younger clients, we've got more sophisticated clients.
Yeah.
You know, don't accept this. Do your due diligence, hold the line and say, we don't embrace this. There is no data. By the way, talking about Blackstone, check Blackstone's share price in the last 12 months. It's absolutely cratered. Blackstone, who get all the best deals. They are the best in the world at this stuff, this private equity stuff. They get access to the best deals, the best opportunities, and their own share price, which effectively represents the quality of their deals.
Which probably comes back to Andy's point that share price is probably plummeting because they own a lot of these 29,000 companies. They can't sell. I mean, every time they're weekly price or monthly price, the price is going down. Oh, look, there's Vanguard over there with a massive retail market.
Yeah, there's a pilot here. Honestly, it's such an important point, this. I'm sort of aware of some of the stuff that goes on. I've got some friends that work in institutional private equity, and the retail market is so attractive to them, billions and trillions that they can, and people who actually, with all due respect, don't really know what they're doing. They don't know a good deal from a bad deal, and they're relying on these other organizations packaging up. You know, trust me, the private equity companies, they keep the best stuff for themselves. They aren't just packaging up and selling it to Vanguard punters, £100 a month savings plans. It doesn't work like that. And so I think it's really important for advisors to hold the line to say, we don't believe in this. We can't find any academic research to support the view that it makes sense. Private equity in itself, there's a strong case for. If you were a shareholder, going back 10, 20 years, of the likes of Blackstone,
BlackRock, KKR.
Not BlackRock, Blackstone, but KKR, Carlyle, all these big players, they've done superbly well. But what's attractive, the bottom line that Jason is kind of referring to is what's attractive to is the kind of modern version of with profits. It's not mark to market. You don't get a daily valuation. So your 10,000, your 100,000 investment is still 100,000 6 months from now.
But is this part of a wider trend where private assets are just burgeoning and they're just spilling out everywhere, and the investment companies are going to have to somehow make a decision and work how they're going to package them, sell them to retail clients?
Yeah, but this is how the market works. If the public markets are attractive enough, you take your company public. You do an IPO. You list on the stock
I'm
market.
talking about private assets, private equity, private property. It seems like private assets are building to an astronomical
of course,
state that we've not seen before.
There's lots of reasons.
So they're just
for
trying
that,
to work out how to package them.
Well, they're worth a lot. I mean, why are they trying to do? They're trying to raise more money. You can raise money as a private company, can't you? You can look for investors. You can have secondaries. You can have other people invest in them. But they're talking about getting access. I just see the retail market as, Mr. and Mrs. Middle England who are trying to save towards their retirement, and I don't see a ready place for this. I'm not saying it's not for everyone. There are some very sophisticated investors it's absolutely appropriate for, but they're already speaking with the private equity companies. I'd rather say, and they're probably getting direct access to some of their deals and their companies. They're not buying a packaged mutual fund or ETF. So you can tell my views on it. I'm not impressed by it, and I think advisors ought to really sort of hold their ground on this and be prepared to have healthy conversations.
But this goes back, Alan, to what we've spoken about before, which is what's your investment philosophy. And if you know and you've researched and you're comfortable with your own investment philosophy, then you will remain steadfast in that. But go back to my point. It's okay to question it sometimes and to be, and to wonder. And we also have spoken before about this playpen scenario whereby you might have private equity, you might have crypto, you might, there's other stuff out there. But this whole, I mentioned a couple of episodes ago about the BlackRock are talking about this, the new 60-40 is a 50-30-20, and they're going down the private equity route. I don't know. I'd be for the retail investors, illiquid things like private equity funds. How can it work? I just don't know how can it work.
You're going to get
for
gating
people
and
who
all
have,
that awful stuff.
Yeah. But people who have amassed wealth and can afford very clearly to put away 2%, 3%, 5% of their wealth into something for an 8 or 10 year period. Well, then maybe it's appropriate. And maybe I would do that if I had an absolute shed load of money. Maybe I would consider that, but I'd be doing my due diligence on my provider, and I wouldn't be doing it in a 50-30-20 scenario in a fund. Absolutely, no way.
See, that's one of the other aspects of it here is tell me about your due diligence. Tell me about your research budget. Mr. IFA, Mrs. IFA up and down the country recommend this. How are you going to research this? Because you're going to need a lot of money and a lot of time and a lot of people to do a proper deep dive analysis of all these various opportunities that exist. As you said, and there's 20,000 companies. Yeah, you could theoretically. So it may well be worthwhile, but I don't think you can justify.
I know
the research budget.
A bunch of guys here in Ireland who've decided to do it themselves. So there's kind of 8 or 10 of them, and they've come together and they've put a partnership together, and they're basically going into, it's more of a VC kind of a startup community that they've done themselves, but it has evolved to existing businesses who are trying to drive on, and they're going, we'll back you because we like the people.
Sure, that's a slightly different conversation, and it's true. And there are people who invest in VCTs and EIS in the UK. And as I've always said, by the way,
angels, syndicates, etc.
Yeah, but I've always said on this, I have done in the past. I've known a company and a founder or somebody who's running a business that's raising money, and you do get a useful tax break on it in the UK. And I've thrown some private personal money at that, and I know some of our clients do. But that's taken the other way around. That's not buying a package of 50, 100, 200 companies that I don't know.
Yeah, but it's just, for me, it's doing it a little bit differently. And I can see that, if you were, that would be really, really interesting if you're into that kind of thing. So I like that idea. I really do. Anyway, it's, I think we gotta, I nail on your investment philosophy, because for 95% of your clients, right, your bog standard investment philosophy is going to be okay. There may be other clients, the wealthier clients, the people who've come into a lot of money, maybe they want a little bit more, and maybe you will introduce them to other people who are doing other things.
As Warren Buffett said, your investment portfolio should be like watching paint dry. If you want excitement, take up skydiving. Don't confuse it with your investment portfolio. Yeah. And he has a point.
I think it'd be easier to skydive than watch the stock market these days with that.
Yeah, that's true.
Well, I would question that. It's trickier than it looks.
Yeah. Mr. Horns, yeah.
Rog, we're at 49 minutes. Do you want to quickly do your auto enrollment, or should we hold it forward to episode?
Yeah, well, look, very quickly. Auto enrollment is auto enrollment.
Let's contain the excitement to a future episode.
No,
Let's
it's,
get it.
Go, get out of the way.
Basically, there's tons and tons of advisors here who are setting themselves up for auto enrollment. Here we go. And then the government have just said, we're going to postpone that again for about the 48th time. And it's like...
What's the reasoning? What's the general reason for these proponents?
I don't really know. I think they're struggling to get providers in. They're struggling to find out to kind of establish who's going to provide the funds. But that's kind of me surmising. Charges, can you put exit penalties? All of this kind of stuff. Is it through master? There's loads of stuff. We don't do it, so it's not affecting us. But I can see people who are like, this is they're waiting and waiting and waiting. And this is going to be the gravy train they're jumping on, and it's like,
When was it meant to come into force, Carl? The first deadline.
Probably 2 years ago, I would say. That's a guess, right? Because
2 years ago was 2020. Sorry,
yeah.
The first deadline was 2022 or something like that. And then when was it meant to come in again?
September, October
this
2025.
Yeah.
Oh,
sorry,
and they
2022,
postponed
2023.
it and not given definition as to...
It's just a freaking nightmare. The amount of companies that have wasted time, effort, energy, systems to get all that ready, and then they're just putting it back. Surely, again, they could just clone what the UK did. Version 1, let's clone what the UK did.
I was going to say that. And instinctively, I'm not a fan of auto-enrollment, but it has been introduced in this country, 10 years or so ago, and it's been a success. And there's we had to do it kind of in the dark, treading through it and get things set. We as the UK, the life insurance companies and the payroll and everything else, and we've done it. And you think, well, there you go, Ireland. Just take our model and sort of just it's part baked. Just stick it in the oven and off you go. So
Nick or Alan, can you remember? Was it postponed or did it launch on the date? I think it launched on the date.
I think it launched on the date with a very soft launch. So loads of, you had to, it was the bigger firms first, wasn't it? So
that's right. Tesco.
Right. It was 1,000 employees or something, and it was just 1% and 1%, and then it became firms with 200 employees within the net, and it went to 3 and 3. So they soft launched it, and
it is really good, Carl. Once it gets going in Ireland, and people get comfortable with it, and they see their initial amount come out of their salary, and they go, well, where the hell is this going to? And then they get a first statement that says, I've got £3,000. They get another statement, £10,000. It really does incentivize an investing culture.
I suppose my thing is, if you want to do what we're doing, which is financial planning for individuals and families, right? It's a totally different business than going
totally
into
different.
Totally,
absolutely.
And trying to do both, I think you're just going to...
No, I'm getting that at all, mate. No, I'm not. No. I'm just saying, en masse, the UK financial services and the regulator and the government launched it pretty well in this country. But as a lifestyle financial planning focused business, which we all are too. I know some of us are more aspirational than others, but we're not. It's a completely different game. It's a complete process admin. You won't have one-to-one conversations with clients. It's transactional.
It's payroll.
Yes, that's exactly what I was going to say. It's the tech that sits behind the payroll. It's just you need to know what you're doing with that and understand all those systems. We used to back in the day do corporate pensions on our event. Like we used to do. You first start off, did everything. Private medical insurance, you name it.
Was that when you were give it a go, merchant?
Yeah. But bit by bit, and actually our small corporate pensions book was actually quite profitable and quite good, quite useful, quite nice to get 50-man, 80-man pension scheme. But eventually you got to start
80 person.
80, yeah. Yes.
No, not anymore. 80-man and or woman.
Okay. Do not go there. Now,
it's actually a topical tidbit. The latest Supreme Court ruling.
Really important to know it is a different business. And you can't.
And my point is, there are a lot of my peers in the Irish market who are saying they're going to do both, and
they can if you set up another department or division or something.
No, really small businesses. I don't know that you can do it. But look, happy to be proven wrong.
So it sounds like September 2025 was meant to be when it relaunched again. So it sounds like it's going to be early 27 or something, Carl. Ages down the line.
Haven't a clue, but
you've got to get the product providers to play both, because the whole point is to keep it super low cost. And they're going to work out their margin. How are they going to make money? How many people are going to... what's the population?
The bulk of auto-enrollment in the UK, Alan, is with Nest, I believe. I don't know what percentage, but I reckon Nest is a complete separate company, Carl, that's set up by the government. It's like a government pension company that invests the money directly and has like an investment analysis team and things like that. I think they've probably got 75% of the money from auto-enrollment. So, yeah, I suppose.
But you could imagine the numbers. Nest initially probably still is burning cash, but in 20, 30 years they'll be sat on billions of AUM. But basically you're dealing with Mr. and Mrs. Miggins paying their 3% on a salary of 15,000 euros or sterling a year. And it's like most life insurance companies, most like IFAs, old style, in the old world.
Apparently they've got. Well, sorry, Nick. Apparently they've got 45 billion AUM at the moment. 45 billion AUM at Nest.
Okay, so imagine that's going to be 450 in just blink of an eye time in terms of how
brilliant, amazing.
Right, that's it. I'm glad we talked about that. That was well worth finishing off the topical tidbits. And I'm guessing that we're about 54 minutes into episode Soissons Neuf of the Real Advisor podcast, TRAP. Let's move on to what many people are also calling the meat and potatoes of the show. And this is an interesting one, because this is an area where I can be quite dogmatic, I know, and I like things to be black and white. This area for me is not black and white, and I've got some conundrums going on in a minute. The couples conundrum. And that could cover a multitude of sins. It could be that you've got a couple in your business and you've had them from day one, husband and wife, he and she, whatever, but you've always never clicked with one of them, or one of them doesn't turn up to meetings. It could be another sort of conundrum where you've worked with someone who's been on their own and then has someone come into their life and the relationship forms. You've always got on with the person who's been in your business as a client, but the new person, you don't know them from Adam. They've never been through the cash flow modeling. You may not personally take to them. There might be someone who, if they come to you as a couple originally, you might have said, you know what, I don't think this is going to work out. And then you've got for me, the third leg of this stool is where you're taking on the children of clients you love, and you're taking on their children, which you want to do really if you want to just protect yourself from this cascading of wealth going away somewhere. But that doesn't always work out as well. And then you're in this tricky situation where you've got the clients are obviously the parents of this person you're going to probably have to sack off, and just there are loads of things around this. So Ultra introduced this subject to the agenda for this episode, and Ultra will be the good old chap to kick it off.
I'm pleased you said this is an interesting subject, because when I brought it up, you all shot me down as usual.
No, I didn't. I did, in the WhatsApp, I did. I actually supported you for once, Ultra, so don't ruin my good work. All right?
I had one supporting vote that time. Okay, so this is I think quite an interesting challenge that often financial advisors and firms have to straddle. I had a quick look before we kicked off. So 2/3 of my clients are couples. So I look after a few individuals that are obviously single, widowers. So 2/3 of my clients are basically couples, and it's the dynamics between it. Are their values aligned? Are their goals aligned? You're right, Nick. When you have the initial meeting, I'm quite strict and dogmatic as well. If you are part of a couple, I want both of you to be there at the initial meeting. I try and find out who's the CMO of the couple, Chief Money Officer, and I do ask that sometimes in early client meetings. I say, who's the CMO of the couple? And they go, what? And I say, who's the Chief Money Officer? And they look at each other and go, him, her, or whoever. There's usually one that's a bit more dominant when it comes to money and finances. They've also got different communication styles. They've got different literacy when it comes to investing and numbers and numeracy. They've got different attitudes to investing. They've got different attitudes to insurance. Some believe in it, some don't believe in it. There's various things that crop up. There's also a lot of difference in spending patterns. Some of them are spenders, some of them are savers, some of them are, live for the day. Others want to be planning for the future. So there's a lot of dynamics going on with it. Sometimes I'm very strict. I want to meet both of them in the initial stage, because we talk about this wealth transfer. The first wealth transfer in this business is spouse to spouse. So usually there's two spouses, and if one of them passes away, the first wealth transfer is from spouse A to spouse B. And if you don't have a relationship with both, then obviously the client may decide to find a new financial advisor, or the money will, leave your business. The second transfer of wealth is obviously going from the surviving spouse to then the children. So that's my starter. Who are we heading over to now to talk a little bit more about your experience with working with couples? Over to you, Alan.
I'll say, let me say a couple of words. Just following up from what you said there, it's interesting. I didn't know what you were going to say, but this thing about engaging with both the partners, the husband, wife, the whatever, the two parts to the family, the head of the family, the couple. Early on, I think we talked about it in the past, but worth reiterating again. Always aim to meet both together. Don't accept just to meet one, and taking that to the next level, because we know that there is almost always a financially dominant of the two. Without being sexist, it is usually the male. Not always, but in my experience, maybe 80% of the time it is. So with
younger clients, I'm finding it's females.
Okay.
Yeah.
Okay, but whoever it is, but I think so. Just a specific that we've embraced for many, many years in our business. So a classic discovery meeting, ideally in our case, an in-person meeting. It's a relatively relaxed conversation. It's all about the kind of their values, what's important to them, the family, all those good things. But as we open it up, we do the same as you do, Andy. We say, normally one person in the family tends to take the lead with the family finances, with the bank accounts, mortgage payments, etc. May I ask which of the two it is? And as you say, one points to the other, or they both point to the same person, or whatever. And
CMO,
then
Chief Money Officer.
No, don't like that, but you stick to it. But then the important thing is say
absolute shambles.
Say it is like they've pointed to the husband, which is often is the case. So very importantly, then, to open up this conversation, you turn to the wife and say, in that case, would you mind, may I start with you with the first question? Because you get them in the conversation very early on. Because the first questions are very softball, very tell me your background, tell me about your story, what brought you here, etc. But you bring them in. What I've learned in the past is that the non-financially dominant part of the couple isn't really keen to even be in the meeting because they think it's a conversation about pensions and stuff. They've been dragged along. So we want to get them involved in a conversation. And if in my case, in this example, the husband has been waxing on about, I did this and I've invested in pensions and I dabbled a bit myself and blah, blah, blah. Yep. And the other half hasn't said a word, 15, 20, half an hour in. It's very, very difficult to engage them in the conversation. So start very intentionally with the least financially dominant person. Tell me about, and you realize that it's not a complicated. I'm not asking you about what your view is on the Sharpe ratio of the latest investment
what's
fund.
your mortgage interest rate?
It's exactly. It's tell me about your background. Tell me about your story. Tell me what does money mean to you? All those kind of softball questions. So I think that's a sort of a tactic that should be used, and it's not done for any other reason other than to make it a much more engaging conversation for all parties. That's worked really well. The only other thing I'm going to chuck into the mix here. You're right. We've had situations where people have passed on. Divorces is one. People have got divorced, so therefore money tends to get split up. It's very difficult. We've tried a couple of times to retain both the subsequent, divorced part of this couples. To my knowledge, I don't think we've ever made it work. Eventually, one party says, "No, I'm going to find another advisor," which is fair enough. And the last thing I'll say, just remembering a brief experience went back quite a few years ago. I was working with this client who was quite an elderly gentleman, and he'd never been married, and he was very well off. And out of nowhere, he found himself a very young partner, and all of a sudden, his spending patterns seemed to go through the absolute roof. Now, that is a real challenge because we're aware of this. The guy lived a pretty humble lifestyle, frankly, certainly relative to the wealth he had. And it made him... I'm not sure what that was about, but...
well, he was spending his money on doing nice things.
Fine. And so we had to navigate that one very, very carefully because he was in love and he kept repeating to me how much in love he was and actually attended their wedding.
That's a vulnerable client now, screaming vulnerable client.
Completely, but you try to navigate that when he says and I'm trying to have a quiet word with him, but without upsetting the new partner. Yeah. Very, very awkward and difficult. I mean, it seemed to work out, sort of. Sadly, maybe 7-8 years later, the elderly client passed away, and
worn out.
and the The other half inherited quite a nice touch and relocated to the United States, and we never heard from him again. So that is, but you got to, again, couples, the relationship, you're aware of one thing versus the other, but you can't cross that border, cross that line. It's a tricky thing, and all we can do is show up, do our best, tell our truth, try to navigate these relationships. But it's not easy. It's not easy.
Sense, a lot of openness.
It is. You're right. It is common sense and just doing what you think is the right thing. And of course, and this wasn't like that. Don't get me wrong. But if there are things, and I have heard some pretty bad stories about people, whether it's abuse of one sort or another, and you got to take that very seriously. Whether it's properly vulnerable clients, and that there's various safeguards and things that we all need to be aware of and put in place. But no, good subject.
Just before we go into the next person, if I've been working with a couple for a while and I know both of them very well, I'm okay for the less financially dominant one not to join every meeting going forward. But if it's happened a few times in a row, I'm like, right, next time, really great to all three of us to get together again. So I'm very strict on in the initial stages. And as you said, Alan, I want the one that's less financially dominant or sort of literate to be involved as much as possible, and to ask as many questions and be as comfortable with the relationship as they can be. But I'm less strict.
I agree. You don't have to attend every single follow-up meeting. Yeah.
Okay, over to you, Carl.
Yeah. Okay, so I was the one who said this was a terrible subject when Andy said that we should talk about couples, and I'm suffering the brute force of karma right now. So we often come on here and say how great our lives are and how great business is and blah, blah, blah. So I'm going to be totally honest and tell you a bit of a shitty story. So we have been working with, I suppose, elderly clients at this stage for 9 years now. And unfortunately, the gentleman in the relationship passed away last year. And I got a phone call this morning from his surviving wife, who I would have thought we got on fantastically well with. And I'm going to leave out some detail, if you don't mind, on this.
Yeah, of course.
It's, I don't want to give away too much detail, but she basically said, we're leaving, Carl. We're leaving Metis. We don't want you to advise us anymore. And I was shocked, taken aback, pissed off, surprised, everything. And when as the conversation evolved a small bit, basically it was the gentleman who valued the relationship he had with Metis. She did attend every single one of the meetings with Metis, but we didn't cover ourselves in glory, I would say, since the gentleman passed away. And she made a call herself that, bugger you lot, I'm out of here. So at your peril, dismiss this subject like I did when Andrew Hart said we should discuss it. And look, I'm being a little bit facetious because, I suppose I'm not in the zone of sitting with the clients anymore as much as I was. It's seldom enough that I'm doing it now these days. So it's not necessarily for me, which is probably, Andy, why I dismissed it, and I must apologize for dismissing it, because this is clearly a really, really, really important issue. And I think further on from that, when you are dealing with elderly clients, to Nick's point about dealing with, when the wealth gets passed on and all that kind of stuff. So I think it is something that you need to be very, very careful about. This is a significant family for us, and I hate losing it. And I think bringing this up today is important, just to say that, running a business like ours is fucking hard.
It's emotional. It's emotional. And the way you describe that, Carl, the gut punch, but also the anger, and it's everything, isn't it? Do you? Yeah. And is part of you also thinking, is there someone whispering in her ear?
I won't go into more detail, but I think I know her kids, and I'll put it this way: her kids were supportive of her decision, which is a further gut punch.
But they're taking a big risk. I'm assuming she's quite elderly. Let's say she's old in the traditional sense.
In the sense of years adding up.
In the sense of years adding up.
Bigger numbers as you go through them. Yeah,
two numbers added together. She's been with you almost a decade. So she's taken a big risk to try and find another full fat.
No, she's probably had a few chats with someone else. It's always much easier. Did you say sorry? She has or hasn't?
She has, and yes. I did speak to her daughter as well. I'm probably saying too much, but so they were fully frank with me as to what has evolved and what has transpired, and so it's look, it just is what it is.
It happens, Carl. It happens to all of us. The thing is to learn lessons from it. Why did this happen?
100%.
After action review, what could it be done differently? And by the way, sometimes there's nothing you can do differently.
Yeah,
sometimes people want a clean break. I love you to death, Carl. Love your team. Love everyone else. I just feel like having a clean break.
No, that's really fascinating, because if we could talk about just this aspect of the couples conundrum, couldn't we? When one of the couples passes away, how to handle it, things to look out for, changing the tone. If we had a Trap Academy, this could be a separate module all on its own, couldn't it?
Yeah,
hey, that's a good idea. Should we start a Trap Academy?
Yeah, the Trap Academy. Very, very. We are totally going to do that, because we have so much experience to pass on to other people. Because I can tell you what should we have learned, what will we learn, is when somebody passes away, here's what we should have done. I now know myself, because they told me. Today, they told me.
Expensive lesson, but a lesson learned, right?
Yeah, and like, do I hold any grudges against them? None at all. They're just beautiful. Like, she's a beautiful woman, a beautiful family.
It's not personal. That's the thing.
It's not. Yeah, but I'm taking it personally. But
we all do.
But it's actually not.
Classic. Don't get personal business. It's a great saying. It doesn't happen in reality.
Yeah. I do have one other, just kind of an aside, right? Just on something Andy said, just something a little bit, that it tends to be the male who's the dominant partner. Exactly like Andy says, right? The younger people, and I mean, I'm counting myself as a younger person.
Yeah, under 50 is a very I'm finding
metric. That the female is at least as savvy, as involved as the male. I had a brilliant comment from a client, it's a couple of years ago now at this stage. So Taoiseach in Ireland is our prime minister, right? So I said, who's the minister for finance in your house? So who does the money? And the husband went
like CMO, but a variation of it.
Yeah, he said, oh yeah, that's me. And the wife piped up and went, he's the minister for finance, but I'm the Taoiseach.
Yeah.
Right. So she was basically saying, he thinks he's all the control, but basically I control.
But you look after the money, I look after everything.
Yeah, but I do think from a female point of view, I think there's, it's definitely becoming more equal. And I can tell you, in my house, I am
more clued up. Yeah,
I am talking to my daughters. Never be dependent on anybody else, and have your own independence. So I think that's changing for the better, for sure.
There's research that I remember reading a while ago that said, regardless of in a face-to-face situation, who says the most, whatever, that something like 70% across the board of household financial decisions are taken by, in this case, in a normal
females,
taken by the female.
Consumer decisions.
What to do with the household, females. The budgets, the
women make all
money.
the consumer decisions. No, that's been proven.
Pardon?
Jordan Peterson, Kathy Newman.
Oh, okay, yeah. I wonder where you were going there. Just one last sort of throwaway, my own personal experience. I remember this conversation has reminded me years ago. Kat and I, my missus and I, were going to get our wills updated and done, and went to a proper London law firm who I'd been recommended to. Sat there in a proper London office. And the guy, perfectly nice male, typical, lawyer, doing family lawyer. And I was a bit uncomfortable whilst he was doing it, because he just kept on just talking to me. Eye contact to me, ignored her the whole time. And you boys know my other half. That didn't go down too well.
I can't see that one ending well.
No. So we came out of that. Did all the had all the conversation. Of course, it's funny when you engage in a conversation, because it takes a while to notice it, because someone's just talking to you and I'm answering his questions and what have you. And then even, sort of halfway through, I'm thinking, oh, you should probably speak to her as well. But we came out of that. We just walked down the street. She says, we are not using them. End of story.
And rightly so. And rightly so.
Exactly,
she is so right. Yeah.
And there's no comeback.
There's no. That's it.
Next on.
But isn't that the point? And I don't know the circumstances of. I mean, I know your team, Carl. They're a great bunch of people. But who knows? Who knows if the person felt that they weren't acknowledged, weren't loved, weren't taken care of, weren't listened to. These are the circumstances. This can happen to all of us. Yeah. Pay attention to everyone in the room.
Okay.
Nicholas.
I'll go last. I'll be quick on this. Yes, I've always said it. I echo what all the trap back believe, that in the onboarding process, you have both couples there or you don't go ahead. It's an immediate red flag. Once they come on board and you've got a relationship, okay, maybe every third or fourth year, one of them can step out. They're just too busy to attend and things haven't massively changed in their financial plan. But you always address both of them. You always try and get both of them talking. You always try and get the quieter one talking, whether it's the male, whether it's the female. And you listen and you show that you're listening. My conundrum with clients is the ongoing thing, as I said at the start of the meat and potatoes, where I've got 3 examples. And again, like you, Carl, I've got to give some colours to this story, but I don't want to give it away kind of thing. But I've got a long-term lady client who in her 40s married last year to a guy who perhaps on paper I wouldn't take on as a client. Personality-wise, I think we're okay, but he has come into her life. She's going to inherit some significant money, and he doesn't have much money. And you're kind of almost protecting these people as well. I was looking at, if that sounds condescending or mansplaining, I don't give a damn. Part of me was thinking in the back of my mind, I hope that this lady's family have looked into this guy and everything. He seems actually now to be fine. But you just have these red flags, and now he's come into the financial plan, but it took a while because this client, the lady's been a client of mine for years and years, and now I've got to sort of sell what I do to him. He doesn't know me from Adam, doesn't understand financial planning. I think he's bought it. We had our first joint Zoom annual planning meeting last year, and he's responded with information that I requested. So that seems to work well, but you've got to really tread through it carefully. Second case is a lady I saw yesterday online, because I don't waste my bank holiday Mondays, me. We had a Zoom meeting with this lady. She's the partner of a long-standing client of mine, a widower, a guy who lost his wife, has children, and him and her are now together as a couple, and she wants some advice on her pensions and everything. Again, he has got considerably more assets than her in this relationship. And towards the end of the meeting, it was just an exploratory get-to-know-you kind of meeting. I said to the lady, it'd be really good if you and your fella at the next annual planning meeting, which like I said, I've got scheduled to contact your chap in October, if the two of you can do it together. And it was really difficult because I said to her, on the assumption you're going to be together at the time, and this is a long going forward relationship, you've got to get it out there. I was saying to her, I can't advise you in a silo and I can't advise him in a silo. You are a couple until you tell me otherwise. So you've really got to come on board. But my phraseology, what I winced as I was saying it, but so I said, just when we've done this meeting, go back and tell your chap you've met this strange guy online. Yeah, I think I can work with him, and then yes, at the next annual planning meeting we'll do it together. But it's navigating. And the final this client conundrum business is when you have children of existing clients referred to you. Again, I don't want to give too much away, but this couple are close to being my longest standing clients, going back to the early noughties. And they referred their son to me a couple of years ago, and I've worked with him. Personality-wise, we're not that simpatico, but he was the son of an existing client, and I tried to give it a go. We've got our Zoom annual planning meeting tomorrow. He sold a property in the last 12 months, and I know he's invested the assets elsewhere, not through under my auspices, which is annoying, but he's also put it into a portfolio of ETFs, and he says gilts and bonds. So he's gone completely off plan with a portfolio that's completely inappropriate for his financial plan. Remembering at all times the plan determines the portfolio. This guy was always fee resistant from the outset. He's probably somebody I wouldn't have taken on, but he was the child of very long-standing clients. And so I think our Zoom planning meeting tomorrow is going to be a case of, well, thanks, but we part as friends, and good luck. And I am a black and white, but I'm a black and white, but I think all of us to a degree are quite black and white. I'm very black and white. Ultra, I think it's quite black and white. There is no black and white with this. This couples conundrum thing, from losing a partner and then dealing with the deceased one who's still on this crazy spinning globe and making sure you deal with them properly. Having people who have their life partner come into their lives relatively late on, when you've been working with the solo person for years and you've got this new thing in the mix. where you've got a widower who finds somebody else, but the wealth disparity is massively different, and the children thing. Who wants to say to your clients who you love, they're really nice people, no, I don't want to deal with your son. He doesn't like. You're going to give him the grace of at least a planning meeting, aren't you? And try to, and that's where I let my guard down. I thought I could mould this person around because I like mum and dad, and he must be like mum and dad. And it turns out there's not enough of mum and dad in him to make it work. And so I've got these three things in my head at the minute. So there we go. So I'm glad we've talked about this. I said Carl is laughing, so I'm getting the empathy vote from Widger, which is good.
I'm not laughing. This guy isn't like, he's not fitting into my practice. He's not like me, so I'm firing him.
FIFO, Nick. I agree with you, mate.
Yeah. But
how will that, if you fire him as a client and you're going to do it nicely and empathetically and all that, how will that sit with your clients, his parents? How does that conversation go?
I think they'll be fine. I know. Obviously, I'll part with this chap. I haven't even done it yet. I mean, Christ, if it happens tomorrow, I'll do it with all the grace I can muster, and I think he'll be fine. He'll be fine to go off on his own. All I manage is his pension part, and he can, if he set up investments on his own, he can switch his pension to a platform on his own as well. And then
I think you might be over. Yeah, go on. I think we might be overthinking it. In our world, it's like they're clients for life. They can never leave us. It's a personal insight if we part relationships. Whereas in the family, like, I've decided to not work with Nick anymore. Okay, fine. We still are. It could be a big thing, but it might be quite blasé.
How the parents take it is that I don't really, because I think they'll probably think,
Nick, you know what?
We know our kin. We know our kin better than you do. We're not so actually surprised. But they won't emote that, of course. But
they probably know he's a nightmare, and they probably. They're expecting him to leave
he's
you.
He's probably the nicest fella in the world.
I know, probably is.
We've decided
he sounds terrible.
No, it's not terrible. It's not terrible. It's just not a fit. And the moment you go invest, offline, and you just
but he hasn't learned how good you can be. You
haven't
sold yourself to him.
Well, I probably haven't sold myself to him, no. But the problem, Alan, to come back, I wouldn't have. If I'd met him cold without any of the backstory, I would not come on board. Yeah. Would not come on board. But I thought, well, okay, Yeah, there you go. Lesson learned. I'd do it again because I don't. Again, you've got to be really careful around this. We're dealing with the people. The children of clients are the people they love most in the world, right? That you hope, typically, right? We all love our children, and we're all one-eyed about it, and we all have unconditional love. So you've got to just think, oh no, I met your son. I thought he was a bit of a tosser, so I'm not going to give him the grace of it. It might not be received too well. Right.
Final point before we wrap up. I've sadly had 4 clients pass away, all 4 men, male, and the husbands, and all 4 of the wives have continued to work with me. So again,
aren't you great?
No. I will because I've set my stall out from the beginning. I was looking after couples and families. No, Carl,
are you listening?
It could have easily happened to me, Carl. I could have easily have lost all 4.
Here he goes.
I'm just saying, I've been very lucky that that's not happened, and it's often and it's been 4 males, so I've lost 4 husbands.
No one knows more about dealing with widows than Andy Harvey.
Yeah, right. Yeah, I deal with widows really well. Female widows are great clients of mine. Fantastic clients. I've been working them for years. They listen to me. They understand investing. They get the caring gene. They're perfect clients. Anyway,
yeah.
It's not playing, is it, Nick?
So
was that?
Our friend Mr. Lincoln.
Oh no,
has dashed out. So
that will teach him. Any final points on that, boys?
No, that's it done. Boys? We should go on to the next section. The next section, which is Nick's gone away to find the postman with a bulging sack of mail, isn't it? Whatever
we all got to go. Oh Jesus Christ! Anyway, okay.
So
have you got the question?
Yeah, I got the question up. Okay, right, so the question
is
from
first
a listener.
One, it's 2 questions, right?
I'm going to read one question. The other one is lengthy, and I think we've addressed it before. So
the first question. Okay, just go.
So the first question is by James B. His social handle is @James_Bullpit. Gentlemen, first off, I should point out that I'm not an advisor, but a personal finance enthusiast. I've been expanding my knowledge for the last 10 years now and struggle with one aspect of advice given in the UK as compared to the US. Why, oh why, do a lot of advisors still recommend de-risking from the date of retirement when most people no longer have a cash event at this point anyway, as in to buy an annuity, I'm assuming. Nothing that asset allocation will want to be nothing that asset allocation will want to be different in decumulation as opposed to accumulation phase. Maybe noting. I still don't understand this point. US advisors do not have this opinion, probably due to historical reasons, but I can't see how it is still relevant today after the pension freedoms in 2015. I'd love your take on this, as I just don't get it. Thanks. Correct. We still have this underlying force that does want to tweak and change couple investment portfolios or individual investment portfolios as they approach retirement and then they live through their retirement. I mean, it is changing. It used to be this cliff edge, have a load of money, build it up, stop at some point, use that money to buy an annuity. So therefore, approaching that point, you wanted to have it as liquid as you can, ideally in cash. This has changed. Pension freedoms have been around for years before pension freedoms because we had the different rules. But correct, a typical retiring couple that hit age 65, there's a very high chance that one of them will make it to their 90s. So this money needs to do what the only sane definition of money is, which is purchasing power, and it needs to maintain its purchasing power over multi-decades. And the answer to that has been in a predominantly global equity portfolio, managing your cash flows on an annual year basis and focusing somewhat on the safe withdrawal rate. So, James, it is changing. The conventional wisdom around this, as I say, is changing, and a lot of the smart advisors are now pushing back on this. But still, the default dogma is you're in retirement, therefore you need to be predominantly in a fixed income type portfolio. But as I say, the people that are being advised that are thinking about this on a slightly deeper level are still being predominantly in the global equity portfolios. Does anyone else want to hazard?
I'll just add to that. I had to read the question twice. This is not about these, phasing into pre-retirement, is it, to these lifestyle funds? This is more that post-retirement, and I think it's driven by and. Go to the roots of this. This is a regulatory / compliance initiative. Our regulator, the FCA, undertook a significant piece of work, and it's ongoing as far as I'm aware. The at retirement, post retirement strategy. We've all got to one degree or another. Every firm should have an investment policy statement, and you're expected to have a retirement investment policy statement as well. So what are you doing differently? Funnily enough, I was just speaking to a journalist the other day. They're going to do an article about this very subject, and I was making the point: there's no difference. You're saving, then you're spending. You've still got the same challenges. You do need definitely a bit more sophistication around your planning, your spending, and keeping liquidity.
Yeah, you need a tighter grasp on what you're actually spending rather than it just being loose.
Yeah, but all of a sudden you haven't removed the desire to have. In fact, if anything, it's changed now. You've got a desire to have a proper income that fulfills your lifestyle expectations, which is rising in line with or ahead of the prevailing rate of inflation. That's your biggest number one goal. What's the way you're going to achieve that? You don't achieve it by changing to, we're now in retirement, we've got a new investment philosophy that's made up of bonds and cash or something. And the journalist, I can't remember her name, but she was really pushing back on this, but that's not all the other firms that I'm speaking to are telling me. I'm afraid this is back to the same thing. You've got an industry which is run by compliance tick box people telling you need to have this. And advisors, I go back to the private equity thing earlier on, advisors either haven't got the ability to, or they just don't want to push back and say, on what basis is it?
But also investment firms are manufacturing products to fit within the client compliance narrative.
Well, exactly.
Smooth return, retirement income portfolios.
Well, they're just building something to fit. Rather than saying why are we doing this in the first place, they're saying, oh, here's one of these things. So you could have the green portfolio or the blue portfolio. They tick that box, and so everyone's happy to have it's the main thrust of being a high quality, real financial planner. You stick within the rules and regulations, of course you do. But you have a thoughtful approach to this and say, we don't quite believe that you need to adhere to this. It's not a strict rule. You need to be aware of it. But I'm not sure what he's referring to the market in the States. They probably just don't do this at all. In the US, they just keep fully invested by the sounds of things.
Yeah, and
Yeah, maybe the point. Yeah,
back to Nick's point, between art and science, right? I think your point is perfect, Alan. This is what real financial planning is, and I know the detractors will go, "Oh, there's the guys on Trap going, the answer to everything is real financial planning," but it actually is. And to your point about spending, I think the spending patterns need to be nailed before retirement. It's too late to be doing it in retirement because you can't really do a plan for retirement or third act or whatever you want to call it. You got to start fine tuning that. And what we found is over time, your financial plan might be a little bit kind of loose at the start, but year on year it gets tighter and tighter and more accurate.
Iterate.
And then you come to, you might well decide to draw down your pension at 60, but in Ireland here, lots of advisors tell their clients, bail out at 60 and take your tax-free lump sum. And then you have to invest the balance in what we call an approved retirement fund. We had pension freedoms way before you guys did, so you copied us on that, which is totally fine, right? But you can invest in my screen has gone off behind me as I said it.
Yeah. Don't try and fix it, mate. You don't want
I won't. No,
blow up.
But you can your pension fund grows tax free, right? So, but once you draw it down, then you got to start paying tax on the drawdowns, and you got to take 4% a year before you're. It doesn't really matter. This is what financial planning will dictate exactly what you need when you get it. But the answer to every question, because the answer to we probably are having time to do the next question, but it's about attitude to risk. The answer to every question is do your financial plan. And the answers become apparent. The financial plan tells you what the answer is going to be. Every question in terms of families' finances can be answered by doing a long-term financial plan. It will tell you into the long term, broadly speaking, how you're fixed, but it can get very accurate in the short term. Very accurate.
I think this is, and we will. I mean, it's the name of this bloody podcast after all. And we will keep banging on about this forever. And I think this is the underlying point. Quite a few of these questions come up and all roads lead back to the same answer.
Yeah.
Actually. And I do feel for, and it's not, this particular guy is not an advisor. He's just an interested observer. He's interested in personal finance. But I have had conversations with other advisors. I think we all have. And particularly with the larger firms, there is a kind of dictatorial policy. You need to do this. You need to tick this box. The client's going to retirement. You need to get into this fund or this structure, this thing, because everything, if you do things at scale and mass, and I think this is a point as well, we are dealing with our firms in particular, we're dealing with affluent clients that the commercials work out. You can afford to get really, really bespoke, really sort of personalized, highly personalized financial planning and all the things we've talked about. If you're trying to do this stuff at scale with tens of thousands of clients, you probably can't. Therefore, so maybe that's where there's a crossover. Some of the firms working with thousands and thousands of clients, maybe they have to, by definition, to tick the box, put them in this risk profiler, put them in this retirement account, because there isn't enough time in the day to do this art and science experience.
Yep.
Nicholas?
I know you just want to pick their battles, don't they?
Okay, I'll just close up on this one. I'm sure you can hear me. Thank you for stepping in then. But I think Virgin Broadband are doing work in the area, so my internet is very, very spotty. Interesting that a guy completely outside of this thing of ours can look into it and see exactly what some of us have been saying for a long time. I think we'll close it on there. Yeah. We're all in broad agreement about this. James, you're absolutely right. James _Bulpit, BULPITT. It's not a painful name. Our thoughts go out to you. Okay, let's move on to we'll do the second question. Is a massive one. So Lewis M. will the first stay anonymous. I know you tell me. M. Lewis, we'll do your question in the next episode, maybe episode. There are loads of Lewis M's. It could be anybody, couldn't it? Or M. Lewis's. We'll do your question in the next episode after Swass on Naft. That'll be set something. Okay, let's move on to what many people call culture. Oh my God, where the hell is there? It's Culture Corner. Jesus Christ, if this doesn't work. All right, okay.
Technical troubles, Lincoln, I think, today. Okay. So
I wouldn't want to be the Virgin Media engineer who's outside.
As soon as this call ends, he's going to get an
earful. Sack.
The Real Advisor podcast are hiring for a chairman.
Fire away.
He'll be driving up and down the streets trying to find the Virgin Media.
As I'm the MD of Trap, I'll do the hiring myself. And I'll send this some firing. Now crack on with it, storyteller.
Right. I would like to recommend a book by a gentleman called Anthony Pompliano. Andy, you ever heard of him? I know the other two aren't done.
Sounds amazing.
Real legend of a person. So he's got a book. I've been following him for quite a while, quite active social media, quite a high-profile person, very interesting character. But his book, this is an interesting one. I think even Carl might be interested. He started writing a book when he had children, just kind of advice to my kids. And he's just like, write one a day or one a week or something. Brilliant. He's now got 65 of these, just sort of short, just 2 or 3 pages.
That's 65 kids.
No, he was allowed to give each more than one piece of advice.
All right.
I think he's got 2 kids.
It's a book of 65 letters by the looks of the link.
Yeah, how to live an extraordinary life. So very simple. It's like one of these classic, letters to my younger self, letters to my children, but of course letters to all of us. And I bought it, read it in about 1 or 2 sittings. It's just really beautifully written. Loads of really, nuggets of wisdom, golden bits of advice that he's given to his children, now sharing it with the world. And it's, as I say, it's an easy read. Download it, read it, listen to it. Highly recommend it. How to Live an Extraordinary Life by Anthony Pompliano.
Brilliant. I'm definitely downloading that. Right up my street. As is Ikigai, which is... Nick nearly getting... Were you laughing or getting sick there? Do you remember, Andy, we debated Eckhart Tolle, The Power of Now, and you loved it. And I was like, I found it really tough going. Well, if like me, you found Eckhart Tolle's stuff kind of, that was hard going. This is a milder version, but some of it gets a bit mad, right? But it's the Japanese... Ikigai is a Japanese word or phrase for... what's your purpose or the meaning to your life? But they go to this community in Okinawa in Japan, and they study, all these really old people and how they're, finding meaning and purpose in their life. It's really good. And the more I'm trying to, I'm reading these kind of books, the more I'm realizing, are you looking for something? You're searching for a bit of meaning there, Carl. And I probably am. And does that come at a particular hour of your life? I don't know. But I thought this one was really good, which is why I'm definitely going to read Alan's book, because this is...
It's on the Audible link, it's really short, 3 hours and 20 minutes, yeah?
So I've got that. It's just beside my bed, actually. It's a short book, isn't it? Short, light blue book.
Start reading it quickly.
Really, really, really good. That's the Ikigai at the... What is it? If
you start reading it now, you might finish it by October, Alan.
Who's next?
I didn't think it was 3 hours.
Ultra. Let's crack on. Come on.
3 hours on Audible. Okay, this is a strong recommendation, this book. It's called Confessions of an Advertising Man. It's by David Ogilvy, who's muted or is known as being one of the greatest advertising men to ever exist. He's the original Mad Men. It's a brilliant book. It's very relevant for our business. How to win clients, how to keep clients, how to manage teams. It's an awesome book. It's not that big. You get through it quite quickly. He's a great wordsmith. He uses amazing words that I can't pronounce or read, but it's a strong recommendation from me. Confessions of an Advertising Man, David Ogilvy.
Good Scotsman.
A good Scotsman. Advisors should definitely.
Good Scotsman. A door-to-door salesman. He did everything. I read that book years ago. It's a very, very good book. And he had
door-to-door salesman.
Fantastic life. Interesting life.
Come on, end this mess, Nick, please.
Yeah.
Come on. Right, okay, all right. I should end this mess. Mine is my Culture Corner is a podcast, citywide podcast. Listen to it today. The two sort of eminent greases at Citywire, Daniel Grote and Lawrence Lever. Daniel Grote has written a long piece about the SGP charges, their revised charges, which came out last year. And I thought I better listen to this and try and understand them for the first time in my life. Listen to it, still don't understand them, but have got a better understanding. I mean, it's clear that even Daniel Grote, who's written this long piece, doesn't quite. There's still a bit of a mess, but basically on ISAs, which are 20% of the SJB book, they've got rid of the 0.5% initial charge, which used to go straight to SJP.
Wow.
And the initial charge that the advisors can levy is now capped at 3%, and the ongoing all-in charge is 1.59%. And on pensions and life, which is the massive part of their book, They've waived the 1.5% initial charge, which used to go straight to SJP's back pocket. That's gone. And again, the initial advice charge is capped at 3% or less if you want to. And the ongoing charge is 1.67% a year. And they've got rid of the exit charges. So it's a big turnaround. I wasn't quite clear where the fund charges. Daniel Grote said these figures, these ongoing charges are kind of fixed. I was thinking, but it surely depends on what underlying fund you go into, because that's part of that mix. But I listened to it, I didn't quite get it. So their charges have come down a little bit. But not by a great deal, but they have waived the exit charges, which is a good thing. So if you want an explanation of it, classic media brand, though, Citywire, all they are is a media brand. And they talk about this long piece that Daniel Grote wrote, and you look at the show notes, and there's no link to it. So a bit of a fail from Citywire, but apart from that.
What a wonderful culture corner, Nick. Thanks for sharing.
Yeah, well, I'm an icky guy.
that's your icky guy.
It's more like a topical tidbit there, but
that is
fine.
a topical tidbit, but that's.
I know. I was struggling. I should have kept quiet and just let you guys talk about living extraordinary lives with icky guys. But there we go. Right.
Thank you, Nick.
Okay.
Are we done?
Hour 40 minutes.
Go and shout at your local virgin.
Yeah, there's something happening with it because it gives them.
He's going to be speeding around the streets of Watford looking for the virgin.
No, not mine. We got through it. And I have to say, not having that microphone in front of me is a bloody liberating thing. I don't care if the quality's not great. This is so much easier. Right, dear Trappists. As episode Soissons Neuf comes to a sticky but pleasant end, another pile of traps slides down the U-bend of Father Time. Thank you. Do leave a review for us. Rate and leave us a review. 6 out of 5 stars is mandatory. Like and subscribe to our YouTube channel. Buy those remaining Trap Live tickets, which are going at like $3,500 a pop now. That is the demand. True story. So until the next time from the Trap Pack, it's adios. Take care out there, and we'll see you on the other side. Goodbye.
Goodbye.
Ciao.
What a fucking mess that was.